Hi, everybody. October 8th, the market update desk with Scott Riley, NMLS 157524. Kind of a later update today. Kind of had a pretty busy day with appointments. There's uh, there's multiple Fed commentaries out there today from different Fed members. Wanted to kind of review those, touch base where we are in the market today. So first off was New York Fed President and one of the most influential members, John Williams, who and he's always a voting member, the president of the New York Fed, spoke yesterday and said he believes the Fed is well positioned to pull off a soft landing, meaning they'll be able to bring down inflation to their 2% target and maintain strength in the labor market and avoid recession. Now, whether all that actually happens is a different thing. This is the commentary and spin that he's putting out there. Now, when he was asked if the latest jobs report changed their view on rate cuts, Williams said he doesn't want to see the economy or labor market weaken, and that the Fed's dot plot chart showing where each of the Fed 19 members believe the Fed funds rate will be at the end of the year is still a very good base case. So he's towing the line. We've had this big inflection moment in the last 2.5 weeks with rates jumping, and we thought there was going to be a lot of commentary out there with Fed members this week, basically showing that they still support what they did on the last Fed meeting, and that is the case. Now, we also had Reserve Governor Adriana Kugler explain that she strongly supported the Fed's decision last month to cut by a half, and she is more concerned with the labor market as opposed to concern with inflation, and said that she wants to keep cutting at a quarter point increment, but if there were further deterioration in jobs, she'd be in favor of cutting rates at a more aggressive rate to get to their neutral rate quicker. Obviously, she is very much on the dove side versus the hawk side, along with Goolsbee. She's one of the more vocal doves, I would say. And then we had the Fed St. Louis president, Alberto Mussolem, and he's not a voter right now, but he becomes a voter next year. So it is important what he's saying out there. He explained that he was in favor of the 50 basis point cut at the last meeting, that the last jobs report did not lead him to think that they should revise the baseline, and the path that is penciled in is still appropriate. He does want to see a more gradual rate cut going forward, however, more in that quarter point rate cut market. So, this is the first wave of these 17 or 18 Fed commentaries that are out there this week. Each of them are going to, really go out and support their decision. Even though we've had this spike in the 10-year and in bonds. So we also had the National Federation of Independent Small Business Optimism Index come out. That rose slightly from 91.2 to 91.5, but it still remains at definitely lower levels. Some of the labor market categories within that index rebounded from the August report. After falling 2 points in August, plans to hire rose 2 points in September. Job openings, which are hard to fill, fell by 6 points to the lowest level since January of 21. It looks like, showing that it was easier to fill those positions. Small business owners are still pretty pessimistic on the economy. Those that expect a better economy only rose by 1 point, but is still very negative at a negative 12%. The uncertainty index, or volatility index, as some people call it, did rise to a record high going back to 1975. NFIB said small business owners are feeling more uncertain than ever, and uncertainty makes owners hesitant to invest in capital spending and inventory, especially as inflation and financing costs continue to pressure on their bottom line. Now, although some hope lies ahead in the holiday season, many Main Street owners are left questioning whether future business conditions will improve, unquote. Small business is still out there, very nervous about CapEx and the inflationary cost to their bottom line and their cost of goods. So they do appear still to be being squeezed on the net bottom line. On the technicals, mortgage bonds continue to slide lower after breaking beneath their 50-day moving average, and declines are beginning to slow. We did see the mortgage-backed securities climb back a little bit today. I think 5 basis points, if I'm not mistaken. So that was a slightly good sign. Maybe we're kind of bouncing a little bit. Now bonds are deeply oversold and are approaching solid support level at 100.18 for mortgage-backed securities. 10-year bond, pretty flat today. We're ended the day again over 4%. I think it was 4.07. So that 4% is a very, very important psychological and numerical barrier for us. We'll keep on top of everything with tomorrow, and then we're not going to have anything on Wednesday as I go under the knife for my knee. Give us a call. We'll help you out. 616-293-2189. Reach out to us if you have any questions. Share on all the socials, please. The Market Update Desk. Have a great evening.